okay? It's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements.
Right.
We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality, and he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lines from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
For
Bloomberg World headquarters. I'm Charlie Pellet. A very slight bounce off the bottom. Red on the screen. The Dow, the S&P, NASDAQ all declining. 10-year yield right now 3.11%. The 2-year yield 3.46%. Stocks lower after job openings data showed that the Fed has more room to raise rates to curb inflation, a resolve that several central bank officials reiterated in the past few days. S&P down 50 to 3980, a drop of 1.2%. Dow Industrials down 340, a decline of 1.1%. NASDAQ down 178, a drop right now of 1.5%. Spot gold down $13 the ounce to $17.24, lower by about 0.7%. West Texas Intermediate crude oil down 5.4%, $91.78 a barrel on WTI. So a down day across the board. What about the outlook for markets heading into the new trading month of September? Megan Horniman is Chief Investment Officer at Verdance Capital Advisors.
Longer term, I'm a bull. I think in the next 3 to 4 months through the rest of this year, it's going to be a really volatile time. We're coming into a seasonal period with September that tends to be very weak. We've got a lot of uncertainty from what's going on with the European gas markets, the Federal Reserve, and we also have the midterm elections coming up.
Best Buy shares up 1.6%. Best Buy surpassed Wall Street's profit estimates after warning a month ago that it was under pressure from waning consumer electronics demand. Two prominent shareholder advisory firms, Institutional Shareholder Services and Glass Lewis, are urging Twitter shareholders to support a proposed takeover by Elon Musk, despite efforts by the world's richest man to back out of that deal. Twitter is down 1.8% right now. Recapping, stocks lower, S&P down 54, a drop of 1.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio and my apartment in Brooklyn, it's Bloomberg Business Week, this Tuesday, August 30th, 2022. I'm Tim Stenovic, still broadcasting from home in Brooklyn while I continue to recover from COVID. Bloomberg senior reporter and host of ETF IQ on Bloomberg TV, Katie Greifeld, is in for Carol Masser this afternoon. She's holding down the fort in the Bloomberg Interactive Brokers studio in New York. Katie, stocks off their lows, but we're still seeing quite the sell-off.
Quite the sell-off. Hangover, I believe, is how some people are calling it. A Fed hangover, if you will.
Yeah, what's gonna cure it? I don't know.
I don't know, but in any case,
we're going to talk about that a little later. More on the macro data that's moving markets too. Also on today's program, the latest when it comes to Elon Musk versus Twitter and high energy prices. Renewables, right? They'd seem like a good thing. Well, we're going to tell you about the bottlenecks that are preventing cheap wind and solar energy from reaching high demand areas. We're also going to get a temperature check of the restaurant industry with the CEO of Open Table. And we've got the authors of a couple of great new books that are out now that chronicle some huge businesses. California Burning is all about the fall of the state's largest utility. And Like, Comment, Subscribe is about how YouTube rose to world domination. All that and more coming up in the next 3 hours. First up, let's get to the Market Drivers Report. And with us now in the Bloomberg Interactive Brokers studio is Kriti Gupta. She's markets correspondent for Bloomberg. Mike Regan is senior editor for Bloomberg Markets. He joins us this afternoon on the phone from New Jersey. Kriti, I want to start with you. It's not much pretty to be seen out there. 43 stocks higher in the S&P 500 right now. 42, I should say. Everything else lower, a sea of red. What do you see in today's trade?
You know, I think what's really striking to me is not necessarily the equity hangover, as you will, the S&P 500 down 1.3%, but I think it's the lack of drivers for it here, especially when you're looking cross-asset. When we think of the kind of pressure you're seeing in the NASDAQ, for example, down 1.5%, I think the gut instinct is to, hey, go look at rates, go look at the dollar, for example. And right now, neither one of them are flashing that kind of volatility that I think would ordinarily, at least in the last couple of weeks, months, arguably the last year or so really provoke this kind of volatility in the equity market. To me, actually, what's pretty striking is that at the same time that you're seeing the stock market drop, you're also seeing the commodity market drop. Oil, for example, Brent crude at a 98 handle, down about 6%. And to me, if you actually look at the way these charts are moving, for a radio audience, this is hard to kind of explain, but stick with me here. It almost looks like they're moving in sync. And to me, that is a good sign because it means that that kind of inverse correlation between commodities and the stock market is perhaps in the early stages of being broken. The idea here being that if oil prices are higher and higher, that essentially feeds into the inflation pressures and then feeds back into higher recessionary odds, which then again weighs on the stock market. But if you actually look at the oil market and the stock market moving together, it means that they're finally on the same page when it comes to growth in the upward direction and the downward direction.
Mike, weigh in here. I mean, when you look at today's trade, again, I see stocks lower. We had a glimmer of green at the open. That quickly faded. Think about what we got from Jerome Powell on Friday. Think about some of the data we got today. I mean, do you agree with Creedy that there doesn't seem to be a satisfying driver here? Or can we chalk this up to, again, sort of the after effects of Jerome and I was going to say Jerome, I don't even know what I was
Jerome
going to say.
and Company?
Jackson Powell, Jerome Powell.
You'll get there,
There we go. Too many J's.
Well, I think the hangover analogy is a pretty good one. I mean, if you look at the data that did come out today, the JOLTS job openings was a surprise on the upside. So still over 11 million job openings in the U.S., near that record high. And I think it's we're back into that good news is bad news type of scenario, especially after Powell's remarks on Friday. And really all the Fed officials who have spoken since then, sort of all singing from the same hymn book at this point. I'm going to show my age a little bit, but
we're ready.
Can't stop thinking about Alan Greenspan back in the day. Used to talk about monetary policy as like running a bathtub. And sometimes you need to go heavy on the cold water. Sometimes you go heavier on the hot water, trying to get that temperature just right. And, it just seems like Powell really intentionally turned that cold water on full blast on Friday. There had been a hint of a little bit of warm water earlier in the summer when the minutes came out and Powell's last press conference where they both sort of discussed the idea of that an aggressive 75 basis point hike in September was not guaranteed. And it's kind of a reversal of that now. And I think, the equity market is still trying to digest those remarks and the subsequent Fed remarks, especially through the lens of this data this morning, where the good news is bad news to some degree, and consumer confidence as well being above expectations really kind of, I think is the main focus for the moment.
Creedy, come on back in here and talk a little bit about anticipation for Friday. 300,000 jobs added to the economy. We can start saying added at this point because we've recovered all the jobs that were lost during the COVID crisis. How much are traders sitting back and waiting for that number? I mean, because volumes still are higher than average on the S&P today.
They are. And what I think is important is not just the kind of perhaps anxiety or jitters going ahead of the payrolls reports, but also I think there's a regional bias here that is really worth paying attention to. For example, in the Asian session, you really did see it become a turnaround Tuesday. The majority of the European session was also in the green just until the Americans started trading. And that's really where you saw a lot of those gains getting faded. So I think, Tim, to your point, a lot of it is going to come down to the payrolls, but it's still unclear what is actually good news for this market. Because on the one hand, higher unemployment or a miss on payrolls is good news because it means, in theory, a less tight labor market. But on the other hand, it means, a less tight labor market. That isn't a very good thing either when it comes to just the strength of the economy as well. So I think there's a little bit of confusion here in terms of how the market's going to interpret bad news and whether bad news is good news.
All right, we're going to have to leave it there. Creedy Gupta is markets correspondent for Bloomberg. She's with us in the Bloomberg Interactive Brokers studio. Also joining us, Mike Regan, senior editor at Bloomberg Markets on the phone from New Jersey. Sign up for Creedy's chart of the day. You can do that at kgupta129 at bloomberg.net. Also check out her Twitter and Instagram at Creedy Gupta News. Let's get a check on world and national news. For that, we go to Nancy Lyons in our 99.1 newsroom in Washington. Hey, Nance.
Thanks, Tim. President Biden will be talking about his crime prevention initiatives this afternoon in Wilkes-Barre, Pennsylvania. He's riding high off a series of legislative victories and falling gas prices. Pennsylvania is one of a handful of states that could determine control of Congress. Former President Donald Trump plans to hold a rally in Wilkes-Barre this weekend. Well, the federal government is looking at ways to move COVID-19 treatment from the public sector to the commercial marketplace. We get the latest on that from Bloomberg's Amy Morris.
The White House has been signaling in recent weeks it will start moving away from being the only purchaser of COVID vaccines, tests, and treatments. White House COVID-19 response coordinator Dr. Ashish Jha has said that commercial sales could start in 2023. Sources tell Bloomberg News that HHS is beginning the process now, but approval of those commercial sales would take months. This as the White House warns it's running out of public funds for vaccines and treatments and will pause free at-home test orders. In Washington, I'm Amy Morris, Bloomberg Radio.
The United Nations and the Pakistani government have launched an emergency appeal for $160 million. That's to help those hit hardest by the floods that are devastating the country. More than 1 million homes have been damaged. More than 1,100 people have died since mid-June. UN Secretary General Antonio Guterres calls the weather event a colossal crisis.
These funds will provide 5.2 million people with food, water, sanitation, emergency education, protection, and health support.
Guterres says it is time to stop sleepwalking toward the destruction of our planet. Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
Thank you so much for that update, Nancy Lyons. Tim Stennebeck in Brooklyn, Katie Greifeld live in the Bloomberg Interactive Broker Studio, both of us here in New York, which brings us to one of the stories that we're talking about this afternoon by Fola Akinobi, our colleague here at Bloomberg News, among the most read on the Bloomberg terminal this afternoon. It's about small crime arrests here in New York surging 25% as Mayor Eric Adams is taking, Katie, a tough stance.
And of course, we're talking about crimes such as fare evasion, petty theft, and offenses committed with children present. Those are helping to drive the increase that we're talking about. Arrests are jumping for subway turnstiles. Arrests for jumping subway turnstiles, there we go, increasing by more than 100% year over year. This, of course, is according to data from the New York Division of Criminal Justice Services and Police Reform Organizing Project. Public defenders say that they're spending time on cases for offenses that had not been priorities in recent years, Tim.
Yeah, it's not quite clear what effect the arrests have had on safety in the city. Some advocates worry that the disproportionate number of people of color included in those arrests will result in a further destabilization of already fragile lives and lead to a new era of mass incarceration. In a statement, Mayor Eric Adams referred to his own experience with police abuse. The mayor was arrested and beaten by officers when he was 15 and expressed his opposition to heavy-handed policing, but he stood by the policy and said his administration is also investing in solutions to give young people opportunities. When I was traveling over the last few weeks, Katie, we stopped in a town just about 3.5, 4 hours from here for lunch. And the people I was speaking to, and they were in a diner in a small town. Mm-hmm. When they found out that I lived in New York, they said, "What are you doing about all the crime there?" We turn on the TV and we just see the crime over and over again.
Was it my dad?
It wasn't
my
your
dad that you were talking to?
But
Because I feel like I have that conversation every day over the phone, yeah.
Yeah, but as our team here at Bloomberg News has written about, it's the perception of crime more so than the actual figures. Check out those stories and more on the Bloomberg terminal when it comes to the discussion of quality of life here in New York City, a very important business story as well. You're listening to Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Another down day for the U.S. stock market. S&P down for a third consecutive day. Right now, we've got the S&P down 48, a drop right now of 1.2%. Dow Industrials lower by 323 points, a decline there of 1%. NASDAQ also lower as well. The NASDAQ Composite Index down 172, a drop right now of 1.4%. 10-year yield 3.11%, 2-year yield 3.46%. Spot gold lower now by 0.8%, $17.24 the ounce. And West Texas Intermediate crude is now slumping by 5.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Kickoff to the close. Bloomberg's comprehensive cross-platform coverage, bringing you insight on what to watch ahead of the U.S. market close, starts right now.
Welcome to Kickoff to the Close. Caroline Hyde, Taylor Riggs, Shonali Basak, joined now by our colleague Katie Greifeld. We are walking our audiences, whether you're watching TV, you're listening to radio, you're on YouTube. We're going to discuss what we're watching heading towards those all-important closing bells. And Katie, it feels as though the market just wants to push lower. They've finally got the mood of the Fed.
Absolutely. We had a hint of green at the open, actually led by tech. Those gains faded very, very quickly, though, and you're looking at just a sea of red on the screen right there.
Yeah, let's dig into the sea of red, because actually volumes are picking up a little bit. We're up about 3% on the S&P in terms of volumes. We are down about 1.2%, 48 points lower on the S&P. You're seeing a drawdown of 1.4% over on the NASDAQ. Big tech feeling the pain. So too are the small caps. The Russell 2000 off by 1.5%, just at 1,854. And the Dow is off by a percentage point. You're a relative outperformer, but still selling off by 320 points, Taylor.
Love that you take us through some of the big equity markets, Caroline, to kick us off. I'm going to kick off the official countdown to the closing bell by taking a look at some of the key things that we really want to walk you through. For me, as always, it is the big economic data. Now, this morning, there was actually a lot between some of the jolts and some of the consumer confidence. But in terms of the fundamentals and in terms of the inflation read, Shonali, for me, it is that housing market data. Now, top line, month over month, the 0.4% increase. Now, the lowest, let me not say the lowest, the slowest pace of increases that we've seen in about 2 years. And the bottom line, Shonali, sort of year-over-year numbers. Is that a peak? Is that what that rolling over in the white line really means?
So we have a long way to go, Taylor, that's for sure. Even though we may have hit a peak, it's still quite high in terms of those price increases. Caroline, what are you watching now?
Well, let's look at price increases. Let's look at price increases, whether they be over in Europe, but also sort of the shorter term versus the longer term, because we saw, of course, record inflation over in Germany, that of course being the beautiful sight from Berlin. We are looking at inflation really being hyped up by energy prices, first and foremost, that we see in Germany. We're looking at an inflation rate really therefore in excess of 8%, coming to 8.8%, close on 9 at the moment. But what's interesting is there seems to have been a bit of a backward-looking expectation if we're looking at energy prices today, Taylor. We saw a significant pullback over in the contract traded in the Dutch contract, for example. We saw really a downward trajectory of 20% in terms of German prices as well. Gas prices come down as it looks as though some of that effort to ensure we're building back up our reserves is actually working over in Germany and Europe at large.
And maybe, yes, some more details about some of those price caps, of course, Caroline, that you know much more about when you think about sort of the European Union efforts to stabilize that market. Katie, though, I would say really hard to see some of the European inflation out of the woods just yet. It's going to be a long winter ahead for them, particularly as Caroline was mentioning, some of those nat gas prices as well with the cold winters coming up.
And it's going to be interesting to see if that divergence between U.S. and European inflation, if July was indeed the peak. But let's switch gears entirely and talk about Elon Musk and Twitter, because it's hard to not watch this one. Of course, Elon Musk's lawyers saying in a filing Tuesday that basically the claims by the Twitter ex-head of security, Peter Zatko, basically support their argument that Twitter had breached the terms of the merger agreement. Twitter, of course, said that those are invalid claims. If you look at the spread, though, between the deal price, what was offered, and Twitter's actual price right now, that spread just continues and continues to widen as Twitter shares continue to fall under pressure.
The fact that this is still going to run and run until October the 17th, it feels death by a thousand cuts. But obviously, this is all building towards that crescendo of when indeed the trial does start, October 17th, Janani.
Yeah, it's certainly a nice distraction for what it's worth for the only game in town, because that is the Fed. And the Federal Reserve Bank of Richmond President Thomas Barkin spoke earlier about the Fed's dedication and curbing inflation and the risk of recession.
We're committed to getting inflation under control, and there's a path to get there. A recession is obviously a risk in the process. I'll just say, for context, nobody ever canceled the business cycle. So when you say there's a risk of recession, it doesn't have to be like a 2008 recession.
So the question is, how deep a recession, how long a recession, when do rate cuts actually start to begin? There's been a bigger chorus here, and even though you do see stocks down, you do see more conviction among a wider range of Fed presidents here on that desire to combat inflation.
And really interesting comments that we just had on TV, Katie, from Jeremy Siegel. Of course, you know him from the Wharton School, professor of finance there, saying that he really does look at these markets and think that 350 is peak and that level is going to hold as we think about the path to rates higher, and actually maybe the market looking at another 150 to 2%. We may not actually have to do that. He really thinks that inflation is going to really start to come back down.
Interesting. I mean, if you sort of boil that together with what we've heard from the Fed presidents, it seems like maybe even if they agree with that inflation will come back down, they're not letting on that at all. It's very much a message coming from the top that inflation is still a very serious problem, and the gas is still going here.
And indeed, you still see the gas still going in certain parts of the economy. When you look at the jobs data, the JOLTS really felt like a good news was bad news kind of a story. The fact that we are still seeing such strength, such tightness, such build-up in overall search. 2 for 1, every single job opening, there's 2 people that could be getting it at the moment in the market. And I think that this really just shows that the Fed Reserve still has a ways to go. Meanwhile, that does it for now. They've got the bandwidth. We're going to have more bandwidth for you in a little bit because we're having the countdown to the close. Just about 30 minutes now, live on TV and radio and YouTube.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Hey, it's Bloomberg Business Week. Tim Stenovic and Katie Greifeld. We are live in New York City this afternoon. Katie, another great simulcast. I'm hoping I'll be joining you. Well, next week, actually. We'll be back together in the simulcast.
You're giving up
quarantine.
on tomorrow?
No, yeah, there's just no way I'm going to test negative tomorrow.
Okay,
I'll test early in the morning, and we'll have to wait and see. Much more Bloomberg Business Week coming up in just a few minutes. We're going to dive into all the Fed speak that we've been hearing in the wake of Jackson Hole. You're listening to Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenevec and Katie Greifeld in this afternoon for Carol Masser. Katie, we've got a lot of economic data today. We got JOLTS data. We got some consumer confidence data that kind of surprised to the upside. We also are hearing from a bunch of Fed speakers. We're going to dive into all of that in just a few minutes with Steve Matthews. He's going to be joining us from Atlanta. First, though, Charlie Pellet, we got to get an update on this market.
Indeed, another day of selling on Wall Street, Tim. The Dow, the S&P, NASDAQ, all declining. S&P down for a third consecutive day. Treasury slumped after an unexpected rebound in August. Consumer confidence sparked a sell-off and pushed the two-year rate to a new multi-year high. Let's begin there. Right now, we've got the two-year yielding 3.46%. The 10-year, 3.11%. S&P's down 51, a decline of 1.3%. The Dow is down 341, a drop of 1.1%. The NASDAQ Composite Index down 176, a drop right now of 1.4%. Spot gold is down $12 the ounce to $17.24, a drop right now of just about 0.7%. Oil is declining after Iraq's state marketing company said exports have not been affected by violent clashes in Baghdad. West Texas Intermediate crude lower, erasing yesterday's price jump again. WTI down now by just about 5.5%. Well, certainly today's economic news helping send stocks lower again today, but markets continue to obsess about the Federal Reserve and Jay Powell. Lindsay Pieggs is chief economist at Stifel Nicolaus. She was interviewed this morning on Bloomberg Television and Radio.
I think the idea of a soft landing or even a soft-ish landing has been now reduced to very low single probabilities at this time. As the Fed told us, he is anticipating and they are anticipating a period of prolonged weakness where there will be ample pain for businesses and individuals.
And again, we do have the 10-year yielding 3.11%, but the 2-year 3.46%. Recapping stocks lower, S&P down 48 points right now, a decline of 1.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, as I mentioned, we got a little bit of economic data today. That JOLTS data showing that the Federal Reserve still has more room to raise rates to curb inflation. We also saw an unexpected rebound in August consumer confidence, rising by more than forecast in August to the highest since May, suggesting that Americans are growing more optimistic about the economy amid falling gas prices. You got to throw in a little Fed speakers to that list as well, and you got yourself the perfect conversation for a Tuesday afternoon. To help take us through that, Steve Matthews, economics reporter for Bloomberg News. He joins us from our Atlanta bureau. Steve, I go to your bio page on the Bloomberg terminal, and I see not one, not two, not three, but 4 stories with your byline already today, all about Fed speakers, including Raphael Bostic, also about Fed officials renewing rate hike theme while staying vague on what's going to actually happen in September. What's the holistic theme that we take away from the days following Jackson Hole?
You know, in the good old days of about a decade ago, August was kind of the semi-unofficial vacation for Fed officials. Nobody would speak in August other than Jackson Hole. And now everybody is out. We heard from John Williams, the head of the New York Fed. We heard from the Richmond Fed President Tom Barkin and also the Atlanta Fed President Raphael Bostic. And the message is, while presumably not coordinated, basically everybody is backing up what Jay Powell said on Friday, which is, you know, it's all about inflation. There's a dual mandate for the Fed to have strong employment, maximum employment, and price stability. And they feel like on the job side that they're there, and all of the work has to be done on the inflation side. And they are saying, you know, after the July rate hike of 0.75 of a point in the press conference, the reaction from markets was Powell said some things that led people to think the Fed is going to pivot. The Fed is about to slow things down. And that was not the message that they wanted to get across. And now you're seeing just about everybody, including Powell, come out and say, we're really serious. We're going to push rates higher, and we're going to keep them there for a while.
And Steve, to that point that they're all delivering that same message, is that degree of unity unusual?
Yes, it is. I mean, it really, often you will hear there's a hawkish wing of the FOMC, there's a dovish wing, and there's like a big difference. And now Kashkari used to be, Neil Kashkari, the Minneapolis Fed president, used to be considered one of the leading doves. Now he's like one of the leading hawks. Bullard at one point was a leading dove. Now he is obviously a leader of the hawkish wing. There really aren't too many wings. I mean, I guess there are some very small, differences. At one point, you had Esther George, the head of the Kansas City Fed, preferring a 50 basis point rate hike instead of 75. But basically, everybody is on board with the direction. I mean, you have 8% inflation. It's lower by the Fed's measure, but still exceedingly high inflation, and everybody is on board with doing whatever they can to bring that down as quickly as possible.
So, Steve, help us make sense of the economic data that we got today, because we're still showing that, JOLTS data, it's almost at a record. The number of jobs that are available for people who are looking to work, pretty much 2 at this point. After going down last month, it's now risen. But we also have rising consumer confidence. That came in above expectations. Help us make sense of that.
Okay, I think the important data there is the JOLTS data. Jay Powell has been citing that and the ratio of the number of job openings to the number of unemployed. It's now 2 to 1. That's very high. They would like to see that come down. They would prefer to see that come down with job openings being reduced not by laying off workers, but they would like to see a more normalized labor market. On the consumer confidence side, that's been driven by gas prices in the last month or so. I mean, gas prices have been falling. They're happy to see that. So it's like it's not a surprise to see consumer confidence rise pretty rapidly in the face of just a kind of a stunning, day-by-day decline in gas prices. So I think that they would not be bothered by that.
Steve Matthews, economics reporter for Bloomberg News, joining us live this afternoon from our Atlanta bureau. Steve, always a treat to talk to you. Thanks so much for taking the time this afternoon. Check out Steve on Twitter at SteveMatthews12. Katie, I'm pulling up gas prices on the Bloomberg terminal. You can do that along with pretty much everything else there.
Great
77 days in a row. It's been falling. It's pretty incredible. The
This is
average
great
price.
news for me. I'm actually driving to New Jersey after work today, and I've been tracking this on my own. Gas is definitely getting cheaper. Still pretty high, though.
Remember those days of New Jersey when it was way cheaper than everywhere else? Those
No.
days are over. It was like 5 years ago. It wasn't even that long ago. All right, we can talk about it during the break. You're listening to Bloomberg Radio. Let's get to World and National News with Nancy Lyons in D.C. Hey, Nance.
Thanks, Tim. President Biden will be talking up his anti-crime proposals this afternoon in Wilkes-Barre, Pennsylvania. White House Press Secretary Karine Jean-Pierre says he'll again call for a ban on assault-style weapons, which Republicans oppose.
A majority of Americans support this. When we talk about banning assault weapons, the NRA opposes it. And so we are going to hear from the president about the importance of making sure that we protect our communities.
Karine Jean-Pierre. Biden is also planning a primetime televised speech Thursday to discuss the, quote, continued battle for the soul of the nation. Pennsylvania is a key battleground state, and former President Trump will be holding a rally there as well this weekend. More women are registering to vote in those key battleground states following the Supreme Court's decision to strike down abortion rights. Bloomberg's Nathan Hager has more from Washington.
The Democratic data analytics firm Target Smart says women have outpaced men in new voter registrations by 11 percentage points in Ohio, 12 points in Pennsylvania, 15 points in Wisconsin. That's all since the High Court's June 24th decision to overturn Roe v. Wade. Georgia and North Carolina have also seen single-digit increases. The group says the new voters are overwhelmingly young and Democratic, women have been an essential part of the Democratic base in past midterms. In Washington, I'm Nathan Hager, Bloomberg Radio.
Indiana abortion clinic operators are filing suit seeking to block that state's near-total ban on abortions. They say it strips away the fundamental rights of people seeking abortion care in violation of the Constitution. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stenovec and Katie Greifeld in this afternoon for Carol Masser. Katie, you might remember that big Bloomberg Business Week story a couple weeks ago, all about BYD. It's the Tesla of China. It's kind of taking the anti-Tesla approach, the anti-Elon Musk approach. Well, among those read on the Bloomberg terminal this afternoon has to do with none other than Warren Buffett and his Berkshire Hathaway trimming its stake in the company just over a month after speculation that the legendary U.S. investor was preparing to shed his entire position in the Chinese car maker. That sent its stock plummeting.
And we are talking about a trim here. We see the Berkshire.
Just the tiniest of trims, right?
Just a hair, a really tiny haircut. They trimmed shares. They're holding in these shares from 20.04% to 19.92%.
Does that even count?
It's a trim. It's a trim. Small for sure.
But I mean, if you were to round that up, it would be 20%, and if you would round the other one down, it would be 20%. I mean, we're talking what, the 100th decimal place?
I'm not going to fact check you on that one, but yeah, if you rounded it, it would come out in the wash. But if you wanted to be very precise, he did trim it slightly. But of course, theories have been swirling about Buffett's plans since a 20.49% stake, identical to the size of Berkshire's last reported BYD position in Hong Kong as of December, entered the central clearing and settlement system last month. And that move actually triggered the biggest slump in BYD stock in nearly 2 years. So even though it was a tiny, tiny trim, it's big news.
All right. BYD spokesperson wasn't immediately able to comment on Tuesday. We should note that representatives for Berkshire to date have not commented. The shares closed slightly lower at the end of trading in Hong Kong. According to Kerry Goh, the chief investment officer at Kemet Capital Partners in Singapore, said that it's most likely profit-taking. It's not their style to sell just because someone says China is uninvestable. Check out this story and more, available at Bloomberg.com and, of course, on the Bloomberg terminal. You're listening to Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. We've got the Dow, the S&P, NASDAQ. They're all moving lower right now. Stocks are sinking after fresh data points to resilience in household and labor demand, affirming the Federal Reserve's resolve to continue to be aggressive in its fight against inflation. So here's where we stand, close to session lows with the S&P down 53, a drop right now of about 1.3%. Dow Industrials down 365 points. That is a drop of 1.1%. NASDAQ on the minus side, down 184 now, a decline of just about 1.5%. By the way, year to date, we've got the S&P down by 16.5%. Two-year yield, let's begin there because that is a multi-year high, 3.46%. 10-year yield, 3.11%. Spot gold down $13 the ounce, down 0.8%, while West Texas Intermediate crude oil dropping 5.5%. WTI now at 91.67 a barrel. So again, recapping, the Dow, the S&P, NASDAQ, all moving lower. S&P down now by 1.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, when we talk about content moderation, we often think about companies like Facebook and Facebook's Instagram app and Twitter. Increasingly, I guess you could say TikTok falls into that conversation as well. But what about YouTube, the video juggernaut that Google bought for a paltry $1.65 billion back in 2006? Well, a new book details YouTube's ongoing struggles with the blurry lines of extremist speech. That book, written by Mark Bergen, our colleague here at Bloomberg News. He's technology reporter for Bloomberg News. He joins us on the phone from San Francisco. His story is featured in the upcoming issue of Business Week magazine. It's an excerpt from that book. You can read it now, though, on the Bloomberg terminal and, of course, online at Bloomberg.com/businessweek. The book coming out, by the way, on September 6th. Also joining us this afternoon, Joel Weber, the editor of Bloomberg Business Week. He joins us from the Bloomberg Interactive Broker Studio. Joel, when you think about excerpting a book the way you did with Mark's book, how do you choose which part and to focus on to actually excerpt in the magazine?
Well, we read every single page months in advance of the book, and then we basically grill him on, the best thing that we could possibly extract.
So pretty collaborative.
And in this case, I think Mark was the one who initially highlighted this and this particular excerpt, and we agreed with them because, boy, there's like this central tension that I think this article, which, again, let's hear it up for Mark's forthcoming book. Like, comment, subscribe, Inside YouTube's Chaotic Rise to World Domination. YouTube is this massive juggernaut. They were successful in fighting off terrorism not so long ago, but as Mark points out in this excerpt, white nationalism has proven to be a different kind of struggle. And, Mark, I'm just going to turn it over to you. Why could they attack or combat the terrorism that was, on the platform versus what we're seeing now with white nationalism? Why can they do one thing but not necessarily the other?
Yeah, thanks for having me. I think that this is I thought it was a great story because it does get at this very fascinating dilemma. That's not just YouTube's dealt with it, I think, more than any other company, just given its size. But it's something that's affected all major internet platforms. And partly, I think there's a couple different reasons. One is just the nature of the way the governments work, as that there's been a lot more in Western governments pressure and willingness to sort of tackle violent Islamist extremism. And we saw there are sort of tech collaborations set in mind. There are there are lists of known terrorists that YouTube uses, and they can ban these certain figures. YouTube is a gigantic digital advertising. It's very responsive to its advertisers. The part of the book's opening scene is this is June in 2017 when they're in the middle of this major boycott over videos, some of which were ISIS allies that household brands were sponsoring, and these advertisers put pressure on YouTube and kind of forced them to act in a way that they hadn't before. And then once they were able to kind of clean up the system to make it amenable that these ads weren't sponsoring videos that marketers wanted, there was less pressure for them. So I think there's a combination where it was sort of very easy politically. Addressing white nationalism is a more complicated, especially in U.S. contemporary politics, problem to thread, and there was less pressure from regulators and advertisers at the time.
Hey, Mark, how do people and machines do this? There's a passage from your book and indeed from this excerpt in the magazine that includes the phrase, use your judgment when talking content moderation. I mean, that's not necessarily a prescriptive rule, right?
Yeah, I thought that was, YouTube was really, it's hard for us to appreciate, but this was in 2006. Starting in 2005, 2006 is when I think when they ran some of their first sort of policy frameworks. And this was really before content moderation existed at this size in the internet. And YouTube had a problem that Facebook and other sort of text-based sites didn't have, which is they have video and they have moving images and they have complications and all that brings. And so this was a team that was pretty scrappy and sort of inventing this on the fly. A lot of them were pretty well versed in the weird dark recesses of the internet. And so use your judgment there were at the time a lot more of a human sort of, you can call it editorial perspective and judgment about where the lines were drawn. And they sort of viewed YouTube as this was a community of users and video broadcasters, and they sort of wanted videos that fit within the boundaries of that community. Fast forward a few years, they've become this global platform, and moderation is this very complicated process that goes down from decisions in a rule book through teams at YouTube and across the globe to these. They largely sort of outsource that will screen footage in the Philippines, in India, in Dublin, in California. And so it's a complicated process where the company increasingly wants to rely on machine learning systems as much as possible, in part because machine learning systems can just process so much video faster than humans, and they're sort of less, they're impartial and they're less, Google cannot be accused of bias, or if they can point and say, listen, we have a policy rulebook and we have machine systems. We don't have humans with biases making these decisions.
That biasy part there is a huge element of where this excerpt kind of culminates, right? Because one of the things that YouTube often says is that dealing with the threat of Islamist extremism on the platform proved easier because multiple governments agree on those standards, right? Whereas with white nationalism, there isn't that same unanimity. So I'm wondering where does that leave things? Because it means that there's more reliance on AI and the code. Ultimately the code is what runs everything here. Where does that really leave things as society continues to have these massive flare-ups?
And we have about 30 seconds, Mark.
Yeah, I think that they've made some significant changes, and partially because of some tragedies that they witnessed. Christchurch shooting, we talked about in the story, even the most recently Buffalo shooting. Every time there's an incident like this, that is often, sometimes these events are live stream on YouTube. Yeah. So they have taken action because of pressure from their employee base and from politicians and from some of these big moments.
Well, it's a great read, Mark. It's an important excerpt. And congratulations on the book. The book is called Like, Comment, Subscribe, Inside YouTube's Chaotic Rise to World Domination. It comes out September 6th. But read this excerpt now. It's featured in the upcoming issue of Bloomberg Businessweek magazine. You can also read it now on the Bloomberg terminal and at bloomberg.com/businessweek. Mark Bergen, technology reporter for Bloomberg News, along with Joel Weber, the editor of Bloomberg Businessweek.
the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session. Caroline Hine, Taylor Riggs, Shonali Basak, joined now by our colleague Katie Greifeld. Filling in for Carol Massa and Tim Stenovic. She is 2-in-1 today. We together go across audience, TV, radio, YouTube to look at a market that is falling hard. The S&P 500 currently off by 1.3%, a third day of losses, Katie.
Maybe actually we're getting to a level that we can call this conviction selling. It's been hard to find a day-to-day narrative, but definitely seems like the mood music has changed a little bit after Jackson Hole. Some really selling days adding up here.
And selling cross-asset as well. The bond market may be leading us a little bit. Let's look at the equity market in general as well, because we are off currently by 1.3% in the S&P, as I say. We're off by 1.1% on the Dow. That's 355 points lower. Big tech is feeling some of the weakness as we see yields push higher. That's off by 1.5%. Let's call it 177 points off on the NASDAQ. And small caps too, being beaten up, 1.6% lower, Taylor.
You're really seeing a lot of red, particularly on a sector level as well. Every single sector here within the S&P is red on the screen. And what you're not seeing there on the screen, but Shonali, I'll verbal it, and I stole this from Gina Martin-Adams in full disclosure, is you're not really getting above 10 or 20% of any stock in any sector that's green. So you're really, even within sector, not even seeing a rotation and some big buying conviction. So really, for the most of the day, you're only getting a handful of stocks in the green. This sector level certainly starts to paint that picture.
Certainly. I'll give you some green. I'll give you some red. If we look at what is in the green, you do have Best Buy. It's profit-topping estimates. That stock is up the most in the S&P, but not by all that much if you think about it, at less than 2%. CF Industries, this is one of the biggest decliner in the S&P 500, down more than 6%. Insiders sold millions worth of shares. Baidu is the biggest decliner in the NASDAQ 100. Sales are slowing, even though profit topped estimates. So there's a lot of mixed bags here when we think about the ADRs trading in the U.S. from China.
Overall, though, it is interesting that China, I think, in some ways is impacting what's happening in the commodities market today, Shonali. We're seeing metals sell off hard. You're seeing aluminium, copper on the downside. We are not just worried about a more hawkish Federal Reserve, ECB, but also a slowdown in China and the impact, of course, of COVID there. I'm looking at what is the Bloomberg Commodity Index having its worst day since mid-July. And really, there's very hard to find any sea of green. I think cattle prices are the only thing on the green side. Even coffee was going lower last time I checked, Katie.
Bull market in cows. I think I stole that from Mike Regan. But when you think about what we're seeing in commodities, obviously that's such an important input into inflation expectations, which the Fed cares deeply about. We heard from Lori Calvasina talking about that earlier on Bloomberg Surveillance. Take a listen.
The Fed at this point in time has said a lot of things that a lot of people who have been more critical of the market rally already understood, that the Fed was going to take inflation seriously, that the Fed was going to tolerate some pain. And I think in particular, the idea that they're going to be willing to tolerate some pain on the labor market is something we really have to dig into.
Again, that was Lori Calvasina of RBC speaking on Bloomberg Television earlier. She did go on to say that they have about a 60% conviction that we actually did see the lows in the market back in June, but it's definitely reasonable to think that markets could take another swing at it.
I really like those comments about people who are not fighting the Fed. You understand you can't be a bull. You can't be a long this market if you believe that you believe the Federal Reserve. And to her point, Shonali, people who were not long this market had already gotten that message. They knew that this was a Fed that was committed to tackling inflation, that the path for yields was higher. And I know that we'll talk about 2023 later, but this is a Fed that is on the move. And it looks like, as Neil Kashkari was saying, Friday, Monday, and today, a market that's starting to get that message.
Neil Kashkari, Thomas Barkin, John Williams, you have a chorus of Fed presidents really just stepping up here and saying they'll do whatever it takes. And now what you have is the market following suit, and the chance of that 75 basis point rate hike is a bigger reality ahead.
The reality of all of this is whether the bond market now starts to anticipate that we go too far, too fast in terms of the Fed. And for me, the reality is also trying to understand really what the data picture is telling us today. We could get anything really from, if you're looking at JOLTS, you're looking optimistic, consumer confidence looking optimistic, then the housing market rolling over. What does that do longer term to dent perhaps some optimism coming from the consumer base, Taylor?
If there was any sort of sigh of relief within that JOLTS numbers, Caroline, I think it was the quit rates. And what I kept hearing from some of the economist notes on the street is that at least we're not getting the type of massive mass quitting, that it slowed down a little bit. That's maybe some sign of the normalization of the labor market. Still massive job openings for every employed person who wants to be, but at least you're not getting sort of the frenzy that we had, and at least some start to some of this normalization.
Absolutely. It could be a sign that some of the edge is starting to come off the labor market, which we know that Jerome Powell wants to see. But to go back to the sort of concept of fighting the Fed, it caught my eye that we have seen, of course, the stock market start to buckle a little bit. We've seen maybe the Treasury market listen to Powell if you think about what the front end is doing. But if you think about the credit market, and Taylor, I know you think about the credit market a lot.
In her sleep, I think she dreams about it too.
The relative lack of movement in spreads. I did see an interesting note from UBS this morning saying that credit markets are way underpricing the risk of a recession. They were way underpriced for what Jerome Powell said at Jackson Hole. And now if you think about the slowdown that we could go into, that's not reflected in spreads.
Janelle, just quickly, I'll jump in. I see your UBS note, and I raised you a Morgan Stanley one.
Okay, bring it.
Janelle, do you know the note I'm talking about?
I do, and it's about the credit canary in the coal mine, this wall of floating rate debt that's also going to come to roost. So I'm with you, both, really. That's what I'm thinking about, too.
I think all of you could dream about credit in one way or another. But, I mean, broadening it out, I think it is interesting that commodities have got engulfed in this sell-off as well. Oil market really hammered hard. We know that there's thin liquidity, and I guess that's speaks to what then of next week? What then when arguably people come back to their desk, if they are or are not? And if we start to get the liquidity to support the market, do we see yet more conviction in this selling? Or actually is it that we see some sort of stabilization and less gapping lower?
Are we a month out from the next Fed meeting? Once we get that, will that maybe start to settle some of the debates? I wonder what we'll debate. If we don't do 50 versus 75, what possibly could we debate for another month on this program once we get an answer to that?
How long the rate hikes last for?
Sure, we'd
How
find,
inverted the
we'd
yield
find
curve
something to
See,
swallow
Caroline, you
about.
could do credit, you could do bonds. Look at that comment. She just sneaks right in
Old
there.
school, old school. Taking me back to my old days in the biography. But overall, I think, Katie, there is this perspective. Also, don't forget earnings. We get a few after the bell. We get the Chewies of this world, HP as well. And we're starting to see, actually, I think Macro Man, Cameron Kreis, had a great piece out on Bloomberg today, really showing that we are starting to see maybe a little bit of weakness in the earnings outlook from these companies. And what does that mean for the forward-looking expectations of where valuations should be on stocks?
Well, we're going to get more data on that after the bell today when we will all come back together. But that does it for now. We're going to be back together again live on TV and radio and YouTube at 4 p.m. for our Beyond the Bell coverage when we take you through today's market close.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld live from New York City. Katie, another great simulcast with our friends at Bloomberg TV. We, of course, have Caroline Hyde, Taylor Riggs, and Shonali Basak there as well. So let's talk a little bit about today's market. And I want to get your idea of really what's happening today because, you know, as you and I have been talking about for days at this point, but weeks up to this, it seems like the Fed did not get its point across at its most recent meeting and had to hit people over the head from Jackson Hole.
Yeah, just to paint it in really physical terms, I do really think it's interesting at this point that maybe you're starting to see people sort of give up in the stock market a bit, at least when it comes to fighting the Fed. But the credit market, when you think about the chart of spreads, I know that people listening on the radio can't see it, but it's really...
Well, describe it.
Say that again?
Yeah, describe it, though, what you're seeing.
It's basically, if you look at spreads, they're below the peaks that we saw earlier this summer. That implies that there's less stress in credit markets. It's kind of like an ink blot test for where you fall on where stock markets are going to go, whether we're going to see spreads crack and widen meaningfully, or if the fact that spreads are contained, whether that's ultimately bullish for the stock market. Maybe the bond traders have it right.
We've come off of some of those lows on the S&P 500, down only 1% right now. The NASDAQ down 1.1%. The Dow down close to 0.9%. Let's go to Washington, D.C. now for an update on world and national news. For that, we go to Nancy Lyons. Hey there, Nance.
Thanks, Tim. President Biden is in Wilkes-Barre, Pennsylvania this afternoon, and in just a few minutes, he'll be talking about his crime prevention efforts and the recently passed bill on gun violence. He'll then return to the Keystone State for a primetime speech this Thursday. Bloomberg Government's Emily Wilkins reports he'll be dusting off his 2020 playbook ahead of this year's midterms.
He's going to come in and start talking again about the battle for the soul of the nation. He's going to slam Republicans for what he says is a threat to U.S. rights and freedoms. Think abortion rights, think things that deal with elections, access to the ballot box.
Bloomberg Government's Emily Wilkins reports the president's approval rating is up 6 points in the latest Gallup poll, but he still faces headwinds from soaring inflation and the threat of a recession. Well, some positive energy news out of Europe. European Commission President Ursula von der Leyen says the European Union has met its gas storage filling goal 2 months early. The bloc is bracing for a tough winter, with Russia limiting supplies and energy contracts trading at elevated levels.
At European level, we have agreed that all member states do jointly save 15% of energy between August now and March 23. The second pillar is we need to diversify away from Russian fossil fuels to reliable, like-minded sources, mainly also to fill our storages.
The latest data on storage levels helped further push down gas and power prices after yesterday's drop of 20% or more for the benchmark contracts. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stenivek and Katie Greifeld in this afternoon for Carol Masser, live from New York City. Katie, among the most read on the Bloomberg terminal, it's about the wealthiest person in the world. We're talking about none other than Elon Musk and how his $250 billion fortune increasingly hinges not on Tesla, but on another company that he is at the top of. I'm not going to say the helm because it's run by Gwen Shotwell, excuse me. We're talking SpaceX here.
I am so glad we're finally talking about Elon Musk. We've made it 70 minutes. If we don't talk about Elon Musk in sort of 30-minute intervals, I get a little bit antsy. Really happy to be talking about this story because it's a little bit unintuitive. You would think Tesla is sort of the crown jewel, the most important, but it's actually SpaceX, which has always been a vital part of Musk's fortune. As recently as year-end 2019, his SpaceX stake was worth $14.6 billion at the time, and that exceeded the value of actually his Tesla shares, Tim.
But that was back then.
That was back then. Bring
Now
us to
his
now.
SpaceX position is, according to a chart that we have on the Bloomberg terminal, just shy of about $50 billion, whereas his Tesla shares are worth just shy of $100 billion. We can go ahead and I'm going to say $110 billion. It's interesting, though, Katie, because if you look at this graphic available on Bloomberg.com as well as the Bloomberg terminal, it shows this steady march higher for his SpaceX stake as the value has increased. It's a private company, so it's raised money at an increasing valuation each time it's raised money, unlike what's happening with Tesla, where the stock has been more volatile.
Yeah, it's a nice little lesson in the private versus the public markets,
Yeah.
because if you think about what happened during the pandemic to Tesla shares, they absolutely skyrocketed. Obviously, under a bit more pressure now as you have the Federal Reserve raising interest rates, those long duration growth type of stocks, such as Tesla, losing their shine a little bit, but SpaceX, slow and steady.
Well, I've got good news for you, Katie, because we're going to be talking more Elon Musk in just a few minutes. You're
Thank
listening
God.
to Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Thing is still very hot. Headquarters, I'm Charlie Pellet. We've got the Dow, the S&P, and NASDAQ all declining. Let's head right over to the first word breaking news desk for today's afternoon call. Here is Bailey Lipschultz.
And good afternoon, Charlie. As you said, stocks are dropping now for a third day as growth stocks continue to fall. The Dow is down 240 points, S&P lower by 35, with the NASDAQ dropping 115 points. The U.S. 10-year yield is at 3.11%, and small caps are down 15. All 11 main S&P sectors are trading lower, with energy, materials, and industrials providing the biggest drags. Nasdaq biotechs fall 1%, transports drop 200 points, semis are lower by 40, while the VIX is higher by 1%. Leaders in the Dow, Nike, American Express, and Salesforce, while Chevron, Dow Inc., and Caterpillar are the worst performers. In deal news, Twitter fell after Elon Musk added 2 reasons to terminate his takeout agreement, and Lucid fell 6% after a filing to sell up to $8 billion in mixed securities. On the earnings front, Best Buy rose after profits were better than feared, and then China's stocks fell on a report Taiwan's military fired warning shots at a Chinese drone. Wrapping things up, look for earnings from Chewy and CrowdStrike after the bell. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey Lipschultz. And to hear live breaking news over your Bloomberg, type Squawk, SQUAWK on your terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, as we just heard from Charlie and Bailey Lipschultz, Twitter shares are lower by more than 1.9% today. This after Elon Musk is asking a Delaware judge to let him amend his counterclaims against Twitter after saying earlier that new whistleblower revelations add to his argument to walk away from his $44 billion purchase of the company. Katie, I don't know about you, but my head's kind of spinning thinking about the ongoing saga between Elon Musk and Twitter.
I'm thrilled. We have months of content here.
Well, I know somebody who's very busy is out in the West Coast. We're talking about Kurt Wagner. He's technology reporter for Bloomberg News. He joins us this afternoon on the phone from San Francisco. Kurt, I don't know how you're thinking about this in terms of content, but certainly good, I think, for job security because Elon Musk has got you, he's keeping you busy. What do we need to know? What does our audience need to know in the latest between Elon Musk and Twitter?
There were kind of 2 things that happened today, and they were both versions of things that have already happened, but with new information. The first is that Elon Musk asked the judge if he could revise his counterclaims against Twitter. So when Twitter sued him, Musk basically sued them back. And now he's saying, I want to update and revise that lawsuit now that I have more information from this whistleblower that I didn't have a month ago, right, when I sent my original counterclaims. So he's asking the judge for permission to do that. Secondly, he sent a letter to Twitter confirming that he's trying to walk away from the deal. Again, he did that already, too. He did that on July 8th. But this new letter he sent, which is, again, saying I'm walking away from this deal, now includes more information from the whistleblower, which, again, he didn't have on July 8th. So essentially, he is trying to bring all the whistleblower information and incorporate it into his defense. And he's bringing the whistleblower kind of front and center in this whole thing.
And how good is this for Elon Musk? Because actually, Kurt, you and I were talking about this on Bloomberg Technology yesterday. A few people have made the argument that this really bolsters Musk's claims when it comes to those bot and those spam accounts. But does that hold water?
See, I'm less convinced that it actually helps him on the bot and spam argument. But I am, I do think that there might be another argument here, which is that he's essentially saying this is a company that's, hasn't been hasn't been compliant with regulatory demands, right? They have a consent decree with the FTC around privacy-related stuff, and the whistleblower is saying the company's not following that, and they're not adhering to that. And so where I think the whistleblower's argument doesn't really hold when it comes to the bot stuff, if he is telling the truth and if it's proved out that the claims he's making are legit, well, then the company could be in other types of financial issues, right? They could be facing fines, they could be facing regulation. And that's the kind of thing that, Elon might say, hey, I'm, now buying a company, I didn't realize there was all this red tape around it. This is new information that I didn't know, and therefore it should let me get out of this deal.
Well, Kurt, we can't see the future, but we're going to ask you to look into your crystal ball and look a few weeks down the line into what the Delaware Chancery Court is thinking. I mean, how does this end?
I mean, Twitter continues to use quite strong language about their intention, right? Which is that they have every intention to enforce the original merger agreement. And to me, I don't think you use that language unless you really do feel that you have a good case here. And so I think from the Twitter side, they want to take this to trial. They think they have a winning hand, and they want to go and prove that out. I do think there's a realistic chance that these sides settle. I don't have reporting to back that up. I don't even know if those types of conversations are happening. But I just think about the unknowns of going into a trial, right? You're really saying you're putting all of this at the decision of one person. And I kind of feel like if you're Twitter or Elon, there's just a lot of incentive to kind of hammer out an agreement before you get there so that you're not necessarily going for either a $44 billion deal or a $0 deal. You could, maybe make peace somewhere in the middle. And that does seem like a reasonable thing that still could happen.
It still could happen, but I mean, what kind of odds would you place on that? I know it's a bit impossible and you don't want to speculate too much, but...
And by the way, Twitter's market cap is about $30 billion right now. Sorry to jump in, Katie.
Yeah, and that's probably inflated some, right? Because people are still, holding the stock thinking that this deal might close, presumably. So, if the full deal walked away, maybe Twitter would be worth $20 billion. I don't know. Again, I'm kind of guessing here. I'm a little hesitant to put a number on what the settlement might be, because again, I'm just totally guessing. But it does feel like something that could happen. I don't know. Let's put it at a 30% chance. Who knows? But it doesn't feel like it's off the table, I guess.
Kurt, just in the last 30 seconds that we have with you, what do we need to be watching for as the drama continues to unfold ahead of the Chancery Court hearing?
Sure. I mean, the next kind of milestone that we are aware of is a shareholder vote from Twitter shareholders, and that's going to happen on September, I believe, the 13th. And that's essentially, Twitter putting forward the initial original deal agreement and saying, hey, shareholders, should we do this? It's expected that it'll be approved. And if it is, then Twitter can kind of say, hey, we've done everything in our power to get this deal done. And that kind of paves the way for the trial in October.
Kurt Wagner, technology reporter for Bloomberg News, keeping us up to date on the latest from San Francisco in the Twitter Elon Musk saga. You can follow Kurt at Kurt Wagner 8 on Twitter. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenivek and Katie Greifeld in for Carol Masser this afternoon, live from New York City. Something a little strange happening in the power grid when it comes to power in the U.S. Power prices are actually dipping below zero. This as renewables stress the U.S. grid. We're going to tell you how that's happening in just a few minutes. First, though, let's get to Charlie Pellet because, Charlie, we got less than a half hour to go.
Indeed, 28 minutes to be precise, Tim. We've got the Dow, the S&P, and NASDAQ all trading lower right now with the S&P down 1.1%. That is a drop right now of just about 45 points. Dow Industrials also pushing lower, down 312 points, a decline of 1%. NASDAQ lower now by 148 points, a drop there of 1.2%. Stocks are falling for a third consecutive day after fresh data points to resilience in household and labor demand, affirming the Federal Reserve's resolve to continue to be aggressive in its fight against inflation. 10-year yield 3.10%, but look at the 2-year 3.46%. That is a multi-year high. Spot gold down $12 the ounce, now down 0.7%, 17.24 the ounce. West Texas Intermediate crude dropping 5.2%, 91.99 a barrel. Lori Calvasina is head of U.S. equities at RBC Capital Markets, and on Bloomberg Radio and Television this morning, she told us the S&P has put in this year's low.
You know, when we sort of think about the trajectory of stocks through the end of the year, we have about a 60% conviction that we saw the low back in June. Now, that doesn't mean we're not going to take another swing at it, that we're not going to see some additional volatility, but I think the market will be hard-pressed to really go too far below that at this point, just given what's already baked in terms of labor market pain.
And today, Bed Bath & Beyond shares are plunging. They are down 11.7%. Bed Bath & Beyond says it will hold a conference call tomorrow to provide a, quote, business and strategic update. Again, Bed Bath & Beyond down now by 11.6%. Recapping, stocks lower, S&P down 1.1%, 2-year yield 3.45%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, as energy costs soar around the world, something curious is happening with increasing frequency in power grids in certain corners of the U.S. Prices are plunging to zero and below. We're talking about bottlenecks that are preventing cheap wind and solar energy from reaching high-demand areas. Noreen Malik writes all about it. She's natural gas and power markets reporter for Bloomberg News. She joins us this afternoon on the phone from Brooklyn. Noreen, I was talking with Katie about this. It's a little hard to wrap our heads around at a time when energy prices are so high, how power prices can actually be plunging below zero. How does this work?
It was a surprise for me, too, to see how frequent it is.
Okay, that makes me feel better because you're natural gas and power markets reporter. So I feel a little bit better about my confusion here.
Negative prices have been around for a while. You know, when California first started its big renewable build-out, like about a decade ago in Texas, you know, you would have, like, solar and wind come on faster than you can build transmission lines, like in West Texas or like the central part of California. So in those areas, when you'd have like a really, bright and sunny day or a windy day, you'd see like those like wind turbines like turning at max speed and like solar panels producing at max quantity more than the transmission lines can take away. So you'd have an excess of supply. So anytime you have stranded power that can't get where it needs to or can't get out of its like little community, it sends prices to negative levels. And it's meant to be a signal like from the grid to these, power suppliers, hey, back off, we have too much supply. And, renewables can keep running at like minus 30 or minus $45 because they get these tax credits. And so, but what's remarkable now is that you are seeing such a glut of supply, and these gluts can last 5 minutes or sometimes they can last hours. But these gluts can send prices to minus $500, minus $1,000, or, $16,000, as there was a case in California for a moment earlier this year.
So is anyone trading this? I mean, I hear this and coming from, the traditional stock and bond market, sounds like a great sort of arbitrage trade. But does the power market not work that way?
No, it does exactly. You hit it on the nail. It's just that the nail on the head, but
all right.
It's just that the group of people that know the nuances of the power market, across the U.S., there's more than 41,000, basically ramps in and off the grid. These are places where wind farms are supplying the grid or gas plants and people are taking it off. So you kind of have to know how to play those local markets. You have to look at things like weather and everything. But you're exactly right. People have noticed this trend, and you are seeing battery developers trying to find those spots where prices are really negative, and they would get paid when prices are negative. They would get paid to fill their storage, and then they could resell that power in the middle of the day for hundreds or thousands of dollars. So that's the ultimate arb right now, and that is super beneficial to the grid. That could help, make sure that we have a way to store all this excess solar and wind and get it to consumers typically when prices are high, so that in the long run will help them.
So should we be thinking about the grid in a different way based on this? Because, look, we look at what happened in Texas last year and then even this summer when the state asked Bitcoin miners to stop mining Bitcoin because they were concerned about this heat wave and the grid being able to withstand that. What does this story tell us about the resilience of the grid and updates needed to the grid across the U.S.?
This is definitely a sign of stress that the grid is needs to be upgraded or changed, because for basically 100+ years, the grid has been set up to take power from these large power plants like coal, nuclear, gas, and just ship them one way to consumers. But with renewables, you have thousands and thousands of more sites, so there's more the generation is dispersed. It's spread out over bigger geographic regions. And on top of that, you're having homeowners and businesses becoming suppliers themselves. They're producing their own power by putting rooftop solar and battery, and you're going to have EVs. And so you're going to have power moving from homes onto grid. So everything is becoming more dynamic. And when you have these negative prices, it shows you the real limitation of power getting stranded. And this is the big debate right now, is how do you solve those negative prices? Do we spend billions and billions of dollars on new transmission or local microgrids?
Right. Hey, this is a great story, and it also speaks to what we're speaking about in just about an hour's time when Catherine Blunt, the Wall Street Journal reporter, has her new book out today, California Burning: The Fall of PG&E and What It Means for America's Power Grid. So have this power theme this afternoon. A big thank you to Noreen Malik, natural gas and power markets reporter for Bloomberg News. She joins us on the phone this afternoon from Brooklyn. Follow her on Twitter at Nartorious. Let's get to more world and national news. For that, we go to Nancy Lyons in Washington, D.C. Hey, Nance.
Thanks, Tim. President Biden is in Wilkes-Barre, Pennsylvania to talk about his anti-crime initiatives. It's the first of several trips he plans to make to Pennsylvania in the next few days. He'll be returning Thursday to give a speech in Philadelphia on protecting democracy. Ukraine has launched an offensive along the southern front of its war with Russia. The Ukrainian military says its artillery hit Russian positions around the Kherson region. Senators Amy Klobuchar and Rob Portman met today with Ukraine's president, and Senator Portman says they've heard the push in Kherson is proving successful.
It's good news because the people in that region are living under the Russian thumb right now and are desperate to be liberated.
Senator Portman says they've heard a few villages in Kherson have been taken back by Ukraine. The Biden administration is also preparing to sell more than $1 billion in missiles and radar support to Taiwan. We get details on that from Bloomberg's Amy Morris.
Sources tell Bloomberg News the sale would be the largest since President Biden took office. It does not offer Taiwan any new military capability, but it will likely prompt protests from Beijing, which has said American arms sales to Taiwan are a threat to its security and a violation of diplomatic agreements. President Biden is facing calls to accelerate American weapons transfers to Taiwan to act as a deterrent against China. In Washington, I'm Amy Morris, Bloomberg Radio.
Former President Donald Trump is bolstering his legal team as he fights the classified document search at Mar-a-Lago. NBC News was first to report Trump has hired former Florida Solicitor General Christopher Kise. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stenevec and Katie Greifeld live from New York City this afternoon. Katie, let's talk a little real estate here. Wow, I mean, it's remarkable that we're seeing these rents go this high. But a new story came out yesterday by Martine Paris about U.S. rents hitting a new record, but focusing on rents here in Manhattan, soaring past $4,200 a month in August.
So we are looking at the Zumper National Rent Index. It shows that the median national one-bedroom rent for a newly listed one-bedroom apartment is now at about almost $1,500. That's up 11.8% over August 2021. If you look at New York City, though, it continues to be the priciest place to be a tenant. Median one-bedroom rent is up almost 40% year over year. Those with two-bedroom apartments are now paying almost 47% more, Tim.
Wow. So the most expensive rents around the country include San Francisco. This is one bedrooms as of August 2022. That's surprising to me, given the softness that we're seeing in the San Francisco market and the office market there as well. San Jose, Boston, San Diego, Miami, LA, Washington, Oakland, and then Santa Ana, California, in Southern California. That rounding it out at $2,160 a month.
Do you want some good news?
What's that?
Do you want some good news?
Yeah, some good news.
Okay. So there's two cities showing a decline.
Okay.
They're the only cities showing a decline. It's Des Moines, Iowa, which is down 12% over last year, and Cleveland, Ohio, down 5.4%. Tim, I feel like you're pretty familiar with Ohio.
Yeah, but my wife's from Cincinnati, which is
That's different
southern
from
Ohio.
Cleveland?
It's like the border of Kentucky. It's completely different than Cleveland, which is
I'm writing this down. I've
Yeah.
never been.
Okay, look at a map. We'll go over it, okay? It's actually a very big state. Well, populous state, I should say.
Right.
Meanwhile, just 10 seconds left on this story, Katie. Goldman says the U.S. housing downturn has further to go as rates continue to rise. Check out these stories and more when it comes to real estate news. You can do that at Bloomberg.com and on the Bloomberg terminal. You're listening to Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ all declining, but let us begin with the two-year. We're looking at a multi-year high on the two-year yield, 3.45%. Right now we've got the 10-year yielding 3.10%. S&P tumbling 49 points, down 1.2%. Dow Industrials down 328, a drop there of 1%. NASDAQ down 160 for the NASDAQ Composite Index, a drop right now of 1.3%. Bottom line here, we do have stocks declining for a third consecutive day after fresh data this morning pointed to resilience in household and labor demand, affirming the Federal Reserve's resolve to continue to be aggressive in its fight against inflation. Tomorrow morning, by the way, key economic data when we get the ADP report out tomorrow morning, jobless claims Thursday, and of course, the all-important jobs report on Friday. Again, the two-year yield, 3.45%. Spot gold down $13 the ounce, down 0.8%. West Texas Intermediate crude dropping 5.2%, 91.94 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. As Russia's war with Ukraine plods on, a pincer movement is advancing toward British households this winter. The price of natural gas has skyrocketed since the invasion, boosting electricity costs and pushing up prices for manufacturing inputs, food, and pretty much everything else. With UK energy demand set to rise in the colder months, the financial pressure on millions of households could soon prove intolerable. Unfortunately, this looming emergency has gotten too little attention during the Conservative Party's leadership race. The winner of the election will need to deliver both short-term relief and longer-term reforms to bolster energy security. By any measure, Britain is likely to face a long, hard winter. The next Prime Minister will need foresight and ambition to forestall the worst. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Well, we are already there. We got less than 10 minutes to go until the close of trading on this Tuesday, August 30th. Let's drive to the close with Amanda Agati, Chief Investment Officer at PNC Asset Management Group. Amanda joins us once again on the phone from Philadelphia. Amanda, good to have you back with us. How are you?
I'm doing great. Thanks so much for having me. I'm delighted to be here.
Well, it's great to have you with us this afternoon. Help us make sense of what's going on here, because Katie and I have been talking about it for the past few days. We talked about it ahead of Jackson Hole, but it certainly seems like equity markets and the bond market as well got kind of the wrong idea of what Fed Chair Powell was going to do after that latest Fed meeting.
Yeah, it's been sort of a progression in terms of market psyche here these last few weeks and leading up to and following the Jackson Hole meeting. I have joked on a couple of calls with clients recently that we went from a nothing burger to a something burger to seriously an impossible burger. There's definitely a pun or a metaphor in there, and I think
not a bison burger.
Well, not quite. That would make sense too, I think. But I think it speaks to the challenge that Chair Powell finds himself in as it relates to messaging and forward guidance and how to keep all of the market constituents and participants happy and content. It's really an impossible task at the moment. And so market definitely took away a much more hawkish tone from Powell on Friday, and I think these last couple of days, certainly the hangover effect from that is really taking control of the narrative here.
She said it, Katie. She said hangover.
She said hangover.
We were talking about this earlier on
what
our planning call.
That tired feeling was. It was a hangover. Amanda, I do have a question though. How do you invest around that? Now that markets may be getting on the same page as what we've heard from Powell, what we've heard from other Fed governors, does that mean it's time to fade this move?
Well, we definitely felt like even pre-Jackson Hole that this rally from the mid-June bottom was kind of exhausting itself, that it was a bit far and a bit too fast given one, maybe two data points coming out of July CPI and PPI that suggested that inflation maybe was taking a pause or at least starting to peak. And so market ran with that one or two data points and saying, all right, we're going to claim victory here that the Fed is effectively done, or basically the path that we're on is the path that it's going to be. And so I think you're seeing the market kind of give back some of that, especially given Powell's comments around we're going to have to be forceful and there's going to have to be some pain. Markets hate that. In the short run, we're not making meaningful changes to portfolio allocations. We battened down the hatches a couple of times in the first quarter and then early in the second quarter to try to position for what just continues to be a really high volatility regime. But we're not making any notable changes as a function of what's going on these last few days.
Why not?
Because I actually think that we're going to start to see more confirmation and evidence of inflation rolling over. And while the Fed, only has a few data points to go on here so far, I think the market has already adjusted on the equity side in terms of valuations, but also on the bond market side in terms of, futures, probability of rate hikes and where interest rates have moved to. Like, the market's really already there. And so to the extent that the Fed stays the course here, I think that the market can, live with it, in air quotes, relative to, some of the fears that are looming larger out there. I think the market's already priced for the path that's ahead. To the extent that the dot plot changes meaningfully and the terminal rate moves meaningfully higher from where we are today, that's going to be a challenge for markets for sure. But we already have a number of rate hikes baked in. And so it's not so much about what happens in September per se. It's really that final destination that matters for markets.
Well, speaking of markets, a headline here that I want to get to. Goldman Sachs will lift all COVID protocols that have kept some workers away. This, according to the New York Post. The memo sent today, obtained by the Post, says that the company will no longer require COVID testing or masks or vaccines as well, Katie.
A real sign of the times. We're definitely going to be following
I have
story.
COVID right now. It's not
You
over.
do have COVID. Yeah. You're a little late to the game, but it did find you. But in any case, let's go back to the markets, Amanda, because I'm curious about the cross-asset signals and this concept of fighting the Fed. Stocks maybe getting on the same page as some of the Fed officials, but we've been talking a bit about the credit markets. If you look at investment grade and high yield spreads, they're pretty contained, well below their peaks from earlier in the summer. And I love the chart of the spreads because it almost feels like an ink blot test, whether that is bearish or bullish for equities, whether, we could see spreads crack and start to rise from here, or maybe the fact that they are contained is that bullish for equities that maybe it's not so bad?
I'll take the optimistic side of that trade and say that because we haven't seen spreads, blow out in a really concerning way. I mean, sure, they're up on a year-over-year basis relative to the all-time, easy, or said they're a little bit differently, tight spread levels. We don't see anything that's like meaningfully concerning in terms of spreads right now. And I think that's reflective of, even though everybody's really concerned about, what comes next in terms of this economic cycle, we're not in and of itself in a recession. We're in a slowing expansion phase of growth. There's a lot of policy levers being pulled around that's adjusting the trajectory of growth. But the canary in the coal mine is usually stress in spreads, and so we're not seeing that. So I think that just reinforces that we're still in a slowing growth path, not, on the edge of recession.
Hey, Amanda, before we let you go, just in the last 30 seconds that we have with you, the lows of June, are we going to retest those lows in the declines that we're seeing right now?
I don't think that we'll retest the lows, no. I think we had such depressed sentiment back in mid-June, and we've actually seen some positive readings since then. U of Michigan survey sentiment went up. We had conference board today that went up. We had inflation expectations coming down. So I think from a sentiment perspective, that's going to keep us from retesting lows.
All right, Amanda Agati, Chief Investment Officer at PNC Asset Management Group, joining us once again this afternoon from Philadelphia. You can follow her on Twitter at Amanda Agati PNC. Well, we are just a couple minutes away from the closing bell on this Tuesday afternoon. The S&P 500 down 1.2%, as is the NASDAQ. The Dow Jones Industrial Average down just about 1% right now. Stay tuned, because in just a couple of minutes, we're going to be joined by our friends at Bloomberg TV for our cross-platform coverage of Beyond the Bell. Keep it here. You're watching Bloomberg Business Week on YouTube or listening to us right now on Bloomberg Radio.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
Just about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Shonali Bassett, counting you down to the closing bell. Here to take us beyond that bell, a global simulcast. We're joined by Katie Greifeld, filling in for Carol Massa and Tim Stenevik, bringing together our Bloomberg television, radio, and YouTube audiences as we really look through what has been a day of declines across the broader benchmarks and declines across the broader asset classes, Katie.
Absolutely. If you look at just the S&P 500, it felt like we fell right at 1030 and we stayed there. It feels like the story this summer has been what can happen in the last 2 hours of trading, a lot of intraday volatility. Not so much today. It was just lower all day.
Volatility, when you think about the return to office conversations, Katie, that we've been having here on this program, as Caroline was talking a lot about that New York Post story, looking at Goldman trying to return people to the office. We've been here 5 days a week. It's not so bad, but I understand the frustrations. We'll continue to talk a lot about that story as we bring it back to these markets, Shonali. And yields on the front end, you're still rising. I've heard a lot of people saying that the path forward continues to be higher, though Jeremy Signal, of course, saying that maybe that 350 number will hold. Maybe that is the peak.
It's interesting to think about that 350 because rate expectations have gone up. There's more of a 70% chance of that 75% rate hike now, more consensus among the markets, more consensus in the language among the Fed presidents, and you see that reflected in the market movement today.
But less consensus among market participants still. I mean, yes, there seems to be more selling, but the strategists are still so bifurcated. You still have the JP Morgans being that it's time to be bullish, whereas Credit Suisse's note globally bearish on stock markets today, just adding to the Morgan Stanleys, the Bank of Americas of this world. We are but 6 seconds until the market starts to settle out. We're down by 44 points, let's call it, on the S&P 500, off by 1.1%, so a third day of losses for the main US benchmark. The NASDAQ off by 1.1% as well, managed to come off of its lows, which was at one point down by about 2%, but still 134 points to the downside. Dow Jones off by almost a percentage point, down 309 points overall. And let's have a little look at what happened on the Russell 2000, because small caps have been in the eye of the storm as well, and we're off by 1.5 percentage points on the day overall, Katie.
A third day of losses, a third day of pretty broad-based selling. If you look at the S&P 500 in particular, just 67 stocks managed to finish in the green, over 400, of course, closing in the red. So widespread pain there, Taylor.
You rarely see a lot of that pain on the individual sector level as well. For a radio audience, the sector best performers, the sector worst performers. There's only one sector in the green, and it's only 0.08%, the banking index, as you think about maybe yields higher and the path for maybe better profitability for the banks. Otherwise, it is all the way red. I'll take you down to some of the bottom. It feels like really big tech and some of the classic reopening risk on trades that are under pressure here. Semiconductors, materials. Otherwise, it's transportation, auto, and energy. Those sectors are off 2 to about 3.5%, Katie.
Just to mix it up, I did find one stock in the green. That, of course, is Best Buy reporting earnings. They beat profit estimates. Of course, that comes a month after they cut their forecast, warned us a little bit. But it was a beat nonetheless, and you did see shares about 1.6% higher, which feels notable on a day like today. Moving on, you did have AMD. This is interesting. They introduced a new line of processors, the Ryzen 7000. And actually, analysts were broadly positive both on this chip's performance and AMD's execution, it did not help shares at all, down about 1.8%. Twitter, I was saying to Tim Stenevic before this started, I get a little shaky if I go too long without talking about Elon Musk. This story is the story that keeps on giving. We all know it. Musk's lawyers saying that the whistleblower revelations on bots means that Twitter has breached the terms of Musk's agreement to buy the company. Twitter, of course, doesn't agree. We're going to see how that one plays out, but shares lower by almost 2%. Just to round it out, I did want to throw an energy name up there, Halliburton. Of course, the entire energy sector is lower today. You do have crude oil down about 5%, hurting the likes of Halliburton.
And let's go straight to it. Let's do commodities right now, because I have the global macro movers, Katie. And as you say, WTI off by 5%, Brent off by 5.4%. This really comes as maybe we dial back a bit of our anxiety around what's happening in terms of violence in Baghdad and Iraq and the output there. But really, it felt more also about a global quandary. Are we going to see a global growth slowdown? Are we therefore going to need less of a demand side picture as well? So supply side, demand side feeding together to bring oil lower. We saw across the board every major commodity down. Metals fell. We're also worried about the China outlook there. We're also seeing the likes of soft commodities on the downside, cotton falling big time. We're seeing overall milk down, natural gas down 2.3% after significant falls in European gas prices, down about 20% as Germany really starts to add to ensure that its supplies are being built up, and what that means therefore for a potential of riding out this winter relatively unscathed thus far. We're looking at the FX market, just a sea of red as well. Strong US dollar as we think of a more hawkish Federal Reserve, strong euro as well as we think of a more hawkish ECB, and we see the Canadian dollar weaken on the back of the oil sell-off. You also see, of course, the Aussie dollar weaken as we see a sell-off in metals and some of that global growth story. Mixed picture when it comes to sovereign bonds overall. UK gilts, you rise in the 30-year in the long end, but a little bit of a bid for the belly of the curve when it comes to Australian and Japanese debt. Taylor.
You see that a little bit on the long end here, Caroline, within full faith and credit. Some buying for price higher, yield lower, particularly on 20s and 30s. But again, as always, it's the front end of the curve that yields are rising and prices falling now back up to 346 that we've talked about on a 2-year. So really firmly surpassing the June 14th highs of this year and going back to highs on that 2-year yield that we now haven't seen since about 2007. So I guess the steepening here that continues with yields on the front end higher, Schnelling yields on the long end much lower.
Yeah, and talking about yields, I want to tie in more commentary from Thomas Barkin, president of the Federal Reserve Bank of Richmond. He reiterated the central bank's commitment to curbing inflation while acknowledging fears of recession.
The pace of when we get back to our target, which is 2%, is uncertain. But as a result, our commitment to bring inflation down, which hopefully you welcome, leads to worries about a recession. And I understand why.
So if you're worried about a recession, the question is how long, how far, and what does that mean for rate cuts? Because on one hand, we're thinking about absolute levels, but there's a lot of question around how long some of this pressure on the market will last for.
And a topic I've been interested in is just comparing and contrasting the stance of the Fed to that of the ECB and other central banks, particularly in Europe, because if we do enter a recession and you do have a Federal Reserve that's cutting, again, I mean, Caroline, I know you've been all over this, the inflation picture elsewhere in Europe, those central banks can't really afford to take their foot off the gas. So you could see really a break apart in the different stances of these central banks.
We are getting some commentary on further sort of corporate spending, consumer spending, Caroline, which I know that you and I will both try to tackle here on this program. We're getting some of the quarterly results from HP Enterprise, of course. We are seeing the third quarter net revenue spot in line, $6.9 billion. Down full year, as we're thinking about the top and the bottom line for the full year. Adjusted EPS full year 196 to 204, spot in line with estimates. They'd previously seen 196 to 210. So perhaps maybe a narrowing, a coming down of sort of the higher end of the estimates, but they're maintaining the floor of that and really looking at least next quarter, those fourth quarter adjusted EPS of 52 to 60 cents. Again, right spot in line of an estimate of about 59 cents or so. Going through some of the free cash flow numbers that look a little bit light in terms of the full year, but overall maintaining that quarterly dividend and a number here that looks just right here in line with estimates. That might explain the unch in the aftermarkets trading.
A big fat unch. Let's have a look at what's happening with Chewy, of course. Big pet company. I know I've got a lot of pet lovers on the lineup with me today, all of you animal lovers. I'm looking at what is actually kind of a lackluster report coming from what is a $16 billion company. We're seeing shares falling after hours as net sales come in just ever so slightly light, $2.43 billion. The market had been expecting 2.45. The adjusted EBITDA came in at 83 million. The estimate had been for 13 million, so that's well ahead. But overall, when you dig into some of the numbers, they're saying the gross margin was expanding, actually, 60 basis points year over year. Net income managed to come in at 22.3 million. But this is a company that says that they're proud of their second quarter, their ability to deliver double-digit top-line growth, margin expansion. Interesting, they call it a rapidly evolving macro environment.
Yeah, rapidly evolving, meaning that customers are having a hard time spending their discretionary income on their pets because pets can be expensive. You're seeing the shares drop now almost 9%, kind of whipsawing aftermarket. Remember, we saw very similar reactions when we talked to Petco a couple weeks ago. The question is, how long does inflation continue to eat into spending, especially when, you know, human food is expensive?
Yeah, that's interesting, though. I think we've spoken, Katie, with some other pet sort of owners and companies who've said that this has been such a COVID secular shift. And once people start spending money on pets, it's really sticky, actually. It's really hard to take them away from that. And they, in many cases, maybe myself included, would rather starve in order to feed that pet. But I'll let maybe some of my personal opinions to the side here as we continue to focus on the data.
I was going to say, I still feel like we're buying an industrial amount of cat food from Chewy specifically. But guys, we got to run, a lot to digest. Chewy shares off by about 8% at the moment. But that does it today for our cross-platform coverage of the market close on Bloomberg Television, Radio, and YouTube. We're going to be back tomorrow at the same time, same place.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld in for Carol Masser this afternoon. Katie holding down the fort live in the Bloomberg Interactive Brokers studio in New York. Well, we just heard from our Beyond the Bell colleagues, the S&P 500 closing down by more than 1%, the Dow down close to 1 full percentage point. Let's get to world and national news. For that, we go to Washington, D.C. for world and national news with Nancy Lyons. Hey, Nancy.
Thanks, Tim. President Biden is discussing his efforts to fund anti-crime initiatives to make our city safer. He told a crowd in Wilkes-Barre, Pennsylvania this afternoon, we need more officers on the street.
I know we expect so much from our law enforcement officers, so we need to support them. That's why my crime plan to help communities recruit, hire, and train nationwide more than 100,000 additional officers, accountable officers, for community policing.
Biden will return to Pennsylvania this Thursday to give a primetime speech on protecting democracy. Do not drink this water. That's the message Mississippi's governor delivered to the residents of Jackson as he activated the National Guard and declared a state of emergency. The move was made as residents in the capital city are without safe running water due to recent flooding that overtook a water treatment plant. Governor Tate Reeves says Jackson cannot produce enough water for everyday things like flushing toilets. The UN and the Pakistani government have launched an emergency appeal for $160 million to help those hit hardest by the floods devastating that country. More than 1 million homes have been damaged. More than 1,100 have died since mid-June. UN Secretary General Antonio Guterres calls the weather event a colossal crisis.
These funds will provide 5.2 million people with food, water, sanitation, emergency education, protection, and health support.
Gutierrez says it's time to stop sleepwalking toward the destruction of our planet. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stenovic and Katie Greifeld in for Carol Masser this afternoon. Live from New York City, it's Bloomberg Business Week. Katie, among the most read on the Bloomberg terminal, this one, not necessarily a story about the markets, though I think it's fair to say we could call it a business story, certainly a geopolitics story, but also a sports story. Cameron Smith, the second highest ranked player in professional golf, is defecting the PGA and instead joining the Saudi Arabia financed Live Golf League.
How much do you know about Cameron Smith?
I don't know anything about Cameron Smith.
I know actually more about Cameron Smith than I was expecting to because
Really?
my brother and my dad are huge golf fans.
I didn't
watch
know
so
that.
much golf.
Are they golfers also, or do they just like watching
yeah.
it?
Well, imagine being a golf fan and not actually golfing. I don't know about that, but yeah, no, they're huge players. They're huge fans. And Cameron Smith, he's really he stands out. He's got this very distinctive hairdo. It's kind of like a mullet. It's long in the back. You can see it under the hat, and he has this mustache that, again, very distinctive. He's 29 years old. He's from Australia. He is the highest ranked player to defect from the PGA Tour. Of course, it was enormous prize money that helped lure away the big stars, including Phil Mickelson and Dustin Johnson, who also I hear a lot about all the time.
Okay, I got to push back a little bit, Katie.
Go on.
I mean, is golf different? Like, you know, you can be a basketball fan, you can be a baseball fan, so you can be a football fan and not play the sports. Is golf different than that?
Have you, do you know how golf is played?
I do, yeah.
Extremely boring, torturous, you could even say. If you don't know what's happening, it's just not interesting.
It's fun to hit the links with some friends.
Okay, yeah, with the bros. Yeah, no, but unless you know how golf is played, I would say it's extremely boring to watch. There is no visual appeal.
Okay. All right. Well, check out this story on the Bloomberg terminal. You can also read about it at Bloomberg.com. It's about the world's #2 golfer joining the Saudi-backed Live in a defection from the PGA. You're listening to a Bloomberg Business Week. Tim Stenovic and Katie Greifeld, and this is Bloomberg Business Week.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a developing story. Snapping going to be cutting 20% of its workforce beginning tomorrow. This according to The Verge. The Dow, the S&P, and NASDAQ all declined today. Stocks fell for a third consecutive day after fresh data pointed to resilience in household and labor demand, affirming the Federal Reserve's resolve to continue to be aggressive in its fight against inflation. After the closing bell, we did hear from HP Enterprise. It narrowed its adjusted earnings per share forecast for the full year. After hours, HPE up by roughly 0.4%. Today, the S&P was down 44 points, a drop of 1.1%. Dow Industrials down 308, a decline of 1%. The NASDAQ Composite Index down 134 points, a drop of 1.1%. 10-year down 230 seconds, 10-year yield 3.11%. The 2-year 3.45%. That is a multi-year high. Spot gold down $13 the ounce to $17.24, a drop there of 0.7%, while West Texas Intermediate crude down 5%, $92.18 a barrel. Goldman Sachs has lifted all COVID-19 protocols, including vaccination requirements, testing, masking, and it is also ordering all staff to return to the office 5 days a week after Labor Day. Recapping stocks lower, S&P down 1.1%, 2-year yield 3.45%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really appreciate it. Well, OpenTable is a subsidiary of the publicly traded Booking Holdings. They've got great insight into what's going on when it comes to the restaurant industry. After all, it pretty much knows in real time how many people are making reservations on the platform now versus pre-pandemic. They can see that data at a given moment. In fact, you can look at OpenTable data on the Bloomberg terminal. We're very pleased to have with us this afternoon Debbie Sue, CEO of OpenTable. She joins us via Zoom from Stamford, Connecticut. Debbie, how are you?
I'm doing well, thank you.
Well, I kind of know the answer to this question because I've tried to make reservations on OpenTable and other apps on, a Tuesday night or a Friday night in Manhattan, and it is not an easy thing to do right now. Has the restaurant industry recovered and then some, or is there just less to choose from post-pandemic?
The restaurant industry has definitely seen a pickup in demand, and we're still seeing that kind of post-pandemic pent-up demand where a lot of us have been cooped up in our houses or our apartments, and there's this need to engage and meet with people, and oftentimes over a meal. And so I think we're still seeing pent-up demand and people going out. So that demand has really held steady, even in places in like New York, where you just announced like Goldman has requested everyone come back into the office. So New York is one of those cities where, versus a city like San Francisco, for example, people are coming back. You're seeing those lunchtime shifts starting to fill up. And so the city is definitely feeling more alive. And certainly it is very difficult to get a reservation on a Friday night. You're also seeing in New York tourist activity and travel activity really coming back in a way that we haven't seen in the last 2 years. So all really encouraging signs for Manhattan.
I swear, I actually got an IB during this program asking me to grab lunch in the fall from a listener and a source. So I guess the business lunch.
Are you going to go?
Yeah, I'm going to go. Of course I'm going to go.
That's what you call a flex, making a reservation.
I mean, I'm not making the reservation. Someone else can. But in any case, Debbie, I am interested to situate this conversation in the broader economic landscape that we're living in, because all we talk about all day, and of course this is on Bloomberg, so of course we would be talking about it, but we talk about inflation, we talk about recession fears, and you are seeing this pent-up demand, like you say, but how resilient do you think that is in the face of some of those big issues that we talk about?
As you mentioned, we're certainly in a challenging macro environment. And I think we're in unprecedented times here because we've not had a recession that's followed, a 2-year essential pandemic. And so we're seeing that demand continue to hold. And I think even once people stop revenge eating, is what we like to call it here at OpenTable, with the shape of work and return to work and what that whole thing, I think the future of work or how work is different post-pandemic. I don't know if we're ever going to get back to a world of how it was before the pandemic. So we have a lot of people who work from home or have a hybrid situation, where now going out to that meal is very much a planned event. Like it's a bigger deal. And we're seeing that in shifts of behavior. Before, we had a lot of walk-ins for our restaurants. We're seeing a channel shift for that, just regular casual walk-in. No, people are now booking 2 or 3 days in advance. Hence, the comment earlier about it being impossible to find a reservation. It's because everyone's booking. Everyone's looking forward to that restaurant at a meal. We used to think that bar seating was the most unattractive seat at a restaurant. We're seeing bar seating go across increase twofold, because those are now very, very desirable seats to sit at a restaurant, because you want to be in the fray, you want to be around people. And so I think it'll be really hard to tell what's going to happen in this macro environment, but I remain very bullish on dining, and I think people are going to continue to crave going out, and they will save pockets of their discretionary income for that event.
Hey, Debbie, before we let you go, I want to get an update on the Open Table business and how you're competing with other platforms like Resy, for example. Give us an update there.
We love competition here at Open Table. I think it pushes us to be faster and more innovative. We are slugging it out with them and other players all the time. At Open Table, we really believe that we are a true partner for our restaurants. We stand by our product. We've continued to iterate during the pandemic and post the pandemic, making sure that we give restaurants all of the tools they need to be running their businesses productively, efficiently, effectively, especially given this macro environment. We've launched features like direct messaging, where now, hosts don't have to just be on their phones SMSing and confirming or calling. You can do that directly through Open Table's products. So we're really looking at all the different ways that we can make from the diner's point of view and from the restaurant's point of view, a more seamless dining experience.
Debbie, 30 seconds left. Just how to support restaurants too, given that we're on the other side of the pandemic, hopefully.
It's tough times. Our industry has gone through some stuff in the last few years. The best thing you can do to support restaurants is to show up. No-shows have always been a problem, but especially post-pandemic, hugely, hugely disruptive to a restaurant's business. A few no-shows a night can be the difference maker of making a profit at night or not. So if you're not going to make it, just cancel and tell the restaurants.
Well, I've noticed that some restaurants are charging for no-shows, which I think is a fair policy. Debbie Sue, CEO at Open Table, we'd love to have you back and talk more when it comes to Open Table and fine dining. She joins us via Zoom from Stamford, Connecticut. Follow him on Twitter at Open Table. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenevec and Katie Greifeld in for Carol Masser this afternoon. As we mentioned, we have a theme of power and electricity generation on this afternoon's program of Bloomberg Business Week. In just a minute, we're going to be joined by Catherine Blunt. She's a reporter for the Wall Street Journal. She's got a brand new book out today. It's called California Burning: The Fall of Pacific Gas and Electric and What It Means for America's Power Grid. You do not want to miss it. First, though, let's get an update on the markets in after hours. Here's Charlie Pellet.
A lot going on, Tim, as you well know. Let's begin with HP Inc. Now, it reported quarterly sales that missed estimates. It also reduced its annual profit forecast on falling demand for PCs and printers, especially among consumers. After hours, HP Inc. down now by about 4%. Also reporting after the closing bell, the pet food retailer, the online retailer Chewy, it cut its net sales guidance for the full year. That guidance missed the average analyst estimate. Chewy shares, they are plunging after hours, down now by just about 8%. Goldman Sachs lifting all COVID-19 protocols, including vaccination requirements, testing, masking. It has also told all of its staff to return to the office 5 days a week after Labor Day. Equities declined again today, marking their biggest three-day tumble since mid-June after another batch of economic data reinvigorated investor nervousness about the Fed's willingness to sacrifice growth to rein in rampant inflation. Amanda Gotti is Chief Investment Officer at PNC Asset Management Group. She was our guest right here on Bloomberg Business Week.
So to the extent that the Fed stays the course here, I think that the market can, live with it, in air quotes, relative to, some of the fears that are looming larger out there. I think the market's already priced for the path that's ahead. To the extent that the dot plot changes meaningfully and the terminal rate moves meaningfully higher from where we are today, that's going to be a challenge for markets for sure.
S&P 500 index down 44 points, down another 1.1% today. The Dow down 308, down 1%. NASDAQ down 134, down 1.1%. 10-year yield 3.11%. But look at the 2-year, 3.45% right now on the 2-year. Spot gold down 0.7%, 17.24 the ounce. West Texas Intermediate crude down 5.1%, 92.04 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, the Camp Fire in Northern California back in 2018, it's the deadliest in California's history. It killed more than 80 people, destroyed thousands of homes, and caused billions of dollars of damage. It was sparked by equipment from PG&E, the state's largest utility. And in 2020, PG&E pleaded guilty to involuntary manslaughter as a result of its role in the Camp Fire. A new book out today chronicles the more than 100-year history of PG&E. It argues that the California utility put profits and politics ahead of maintaining its infrastructure. Catherine Blunt is renewable energy and utilities reporter for the Wall Street Journal. She's the author of the new book. She joins us this afternoon from San Francisco. Catherine, great to have you. Congratulations on the book. How are you?
Thank you so much. I really appreciate it. I'm doing well. Thanks for having me.
Good. Well, I'm from the Central Coast of California, so I grew up with PG&E really in my backyard. It was a place where a lot of my friends' parents worked, just down the road at the Diablo Canyon nuclear power plant. And I'm wondering, for people outside of California, how you explain PG&E, because I think for a lot of people, it's much more than just a utility.
That's absolutely right. I think it is more than that. And really, PG&E's failures is a story of systemic breakdown. It occurred over a long period of time as a result of conflicting priorities and a long-running mismanagement of spending and risk. And in this book, I attempt to look at really the past 20 years, which have been it's kind of the most salient time period for understanding why the company fell in the way that it did, and as well as the external factors that created the really challenging circumstances that it now faces.
And Catherine, you've been covering this, or at least for the Wall Street Journal, covering this since 2018. Walk us through some of the key players here who are important in this story about PG&E.
Yeah, so to think about the last 20 years, I think it's important to remember the energy crisis that resulted from California's push to deregulate the electricity industry. It pushed PG&E into its first bankruptcy. The company emerged very intent on reestablishing itself as a strong financial performer and pleasing shareholders. One way that it did that was to attempt to cut expenses in a way that ultimately had real consequences for the safety of its infrastructure. And at the same time, the company was also procuring large amounts of wind and solar power, which at the time were much more expensive than they are today, as a result of goals set by the California legislature and enforced by the regulatory body tasked with overseeing utilities in California. And the company really did a lot to make good on these goals, but in doing so, kind of created additional challenges for itself because it had a lot of expenses that needed to be passed through to customers. So there's been a lot of internal mismanagement over the years, but there's also been certain regulatory and political challenges that are very relevant too.
Well, I'm wondering, Catherine, really specifically about the legislature and the governors over the years in California and the role that they had, the lawmakers, the role that they had in the fall of PG&E.
Sure. So, the legislature isn't directly tasked with overseeing PG&E. That's left to the California Public Utilities Commission. But, there was a series of governors who increasingly set increasingly ambitious targets to cut carbon by procuring wind and solar power. Wind and solar are some of the cheapest forms of generation today, but when 2005, 2010 timeframe, they were much more expensive. And so in setting these goals, the utilities were forced to go out and contract for really expensive power that had financial implications for all of the utilities. But when it came to making sure that the utilities made good on these targets, that was left to the California Public Utilities Commission. And frankly, that was the sexy place to work within the agency. It was the place that had the most cachet in overseeing the procurement of these contracts, whereas the safety division historically was pretty understaffed. They simply didn't have the manpower to make sure that the utilities were doing enough to maintain their infrastructure, and that was particularly problematic within PG&E.
Sit tight. We're speaking with Catherine Blunt. She's renewable energy and utilities reporter for the Wall Street Journal. She's the author of the brand new book. It's out today. It's called California Burning: The Fall of Pacific Gas and Electric and What It Means for America's Power Grid. She joins us this afternoon via Zoom from San Francisco. We're going to do some news, Catherine. We're going to take a quick break, and then we're going to come back with much more. On the other side, what I'm interested in hearing about specifically is what PG&E is doing on the other side of bankruptcy, what the company is doing in its plans to prevent tragedies like the Camp Fire from ever happening again, its efforts to put power lines underground and tap more into renewables over the next few years. You're listening to Bloomberg Business Week on Bloomberg Radio. Let's get to world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. We're getting some late breaking news here. There are reports coming from Russian news media that former Soviet President Mikhail Gorbachev has died. He was the last president of the USSR, and he led his country out of the Cold War era. Again, we're hearing that former Soviet President Mikhail Gorbachev has died. President Biden says he is determined to see military-style assault weapons banned in the U.S. Speaking in Pennsylvania, Biden said they are the weapons of choice for mass shooters.
We have to act for those families in Buffalo, Uvalde, Newtown, El Paso, Parkland, Charleston, Las Vegas, Orlando. I've been to every one of those sites.
Biden also noted guns are the #1 killer of children in America. He says they should be learning to read in school, not taking part in duck and cover drills. Biden will be returning to Pennsylvania Thursday to hold a primetime speech on saving democracy. It is a sign how important he sees it as a battleground state. Former President Trump will also be holding a rally there this weekend. More women are registering to vote in key battleground states following the Supreme Court's decision to strike down abortion rights.
The Democratic data analytics firm Target Smart says women have outpaced men in new voter registrations by 11 percentage points in Ohio, 12 points in Pennsylvania, 15 points in Wisconsin. That's all since the High Court's June 24th decision to overturn Roe v. Wade. Georgia Georgia and North Carolina have also seen single-digit increases. The group says the new voters are overwhelmingly young and Democratic. Women have been an essential part of the Democratic base in past midterms. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much for that update, Nancy Lyons. Tim Stenovic and Katie Greifeld live from New York City. It's Bloomberg Business Week on this Tuesday afternoon. Katie, before we get to this story about European energy prices, is there anything you want to tell the audience about golf?
Oh, just that it's super boring. You know, I was thinking about that more.
We're getting a lot of pushback from your comments about golf.
I mean,
earlier.
I will die on this hill. It's a boring sport to watch. It's fine. This is someone who doesn't play golf but watches a lot of professional golf. It's boring unless you actually are a player yourself.
Okay. I guess
I want
that is a hill.
Tim, I want you to go home and I want you to watch some professional golf and then we can talk about it tomorrow.
Well, I am at home.
Okay. Well, I want you to log off and I want you to go watch golf tonight.
Let's talk about energy because in just a few minutes, we're going to be back with Catherine Blunt, reporter for the Wall Street Journal. She's got the new book out, California Burning, the Fall of Pacific Gas and Electric, PG&E, and what it means for America's power grid. In the meantime, we're keeping a close eye on European energy prices. They're actually plunging as the EU plans to intervene in the crisis.
And when we say plunge, we mean that German power for the next year, it settled 20% lower. Dutch natural gas fell as much as 11%. Both of those benchmark contracts extended losses from Monday after surging to records last week. So still high, but definitely falling, Tim, as investors maybe digest this news.
Prices have been extremely volatile in recent days amid thin trading and much uncertainty. Russia's Gazprom plans to shut the Nord Stream pipeline to Germany for 3 days of maintenance beginning on Wednesday. Now, we should note that the European Union is preparing to intervene in the short term to dampen soaring power costs, which have fueled inflation and increased the risk of a recession. Meanwhile, storage sites in the region are filling fast, bringing some relief and raising the chances that Europe will get through the winter with ample supply.
And we did hear from the Commission president earlier this week that the European Union's power price setting system is no longer functioning properly, requires changes, of course, after Russian President Vladimir Putin turned energy into a weapon. That's a quote.
Check out this story available on the Bloomberg terminal and at Bloomberg.com as well. You're listening to Bloomberg Business Week, and this is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Snapping, planning to lay off around 20% of its nearly 6,500 employees following weeks of planning, this according to The Verge. Earnings news after the bell. HP Inc. reported quarterly sales that missed estimates. It reduced its annual profit forecast on falling demand for PCs and printers, especially among consumers. After hours, we've got HP Inc. shares down now by about 3.5%. HP Enterprise narrowed its adjusted earnings per share forecast for the full year. Shares now trading unchanged. Pet food retailer Chewy cut its net sales guidance for the full year. Shares are down by 8% on Chewy after hours. Goldman Sachs lifting all COVID-19 protocols, including vaccination requirements, testing, masking, and it's ordered all staff to be back in the office after Labor Day. Stocks lower today with the S&P down 44, down 1.1%. The Dow down 308, down by 1%. Nasdaq down 134, down 1.1%. Two-year yield 3.45%. 10-year yield 3.10%. Spot gold down 0.7%, $17.24 the ounce, while West Texas Intermediate crude was down 4.9%. WTI 92.22 a barrel. So again, recapping, down day on Wall Street. The stock sell-off deepening with the S&P down by 1.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. I want to get right back to our next guest, who we were talking to before the break, Catherine Blunt. She's renewable energy and utilities reporter for the Wall Street Journal. She's the author of the brand new book. It's out today. It's called California Burning: The Fall of Pacific Gas and Electric and What It Means for America's Power Grid. Catherine, I want to talk about the piece of equipment that was deemed responsible for the Camp Fire breaking out a few years ago. As I mentioned before the break, it's the deadliest fire ever in California, killing more than 80 people. You have some incredible information in your book about this piece of equipment, a hook that was attached to a high voltage wire. And you write that the FBI analyzed the hook and it revealed that it was actually close to being the same age as PG&E itself.
That's right. So this was a piece of equipment that actually, the transmission line in question that failed and started the campfire, it was built by one of the only real rivals that PG&E ever had. It was a company called Great Western Power. The two companies merged in 1930 to create the monopoly that we know today. But the hook that you're referring to was installed around 1921. It cost less than $1. And it hadn't been replaced. So it had, worn down little by little with every windstorm over the course of a century until it finally gave way.
And so stats like that, just amazing detail there. When you think about that and you think about sort of the state's push for deregulation, how much blame can we place on that versus the fact that some of this equipment was just so old?
Right. So there's really two primary consequences of deregulation. The first is that, it pushed PG&E into its first bankruptcy, and upon emergence, it faced a lot of pressure to please shareholders. And so part of the way that it did that was it reduced maintenance and operations spending on the system, which had long-term consequences for its overall safety because in some respects it reduced inspection frequency and inspection thoroughness. The other consequence is that deregulation completely changed the way utilities produce and procure power. So instead of building power plants that they owned, they would instead contract for power. And as the state pushed for, carbon reductions, that meant procuring a lot of pricey wind and solar that put additional cost pressure on the company. So, the company should have recognized much earlier that this hook was very close to failure, but its inspection methods had changed to the point where it was unaware of the risk until it failed.
So PG&E, Catherine, has emerged from bankruptcy. They've got a new CEO, and they've promised to make changes. What does post-bankruptcy, post-Camp Fire PG&E look like? What specifically have they promised, and what's the progress that they're making in achieving those promises?
Yeah, absolutely. So a new CEO took over in January of 2021. Her name is Patty Poppe. She came from Consumers Energy in Michigan. Last summer of 2021, a tree fell on a distribution wire in the Feather River Canyon not far from Paradise, which was destroyed in the Camp Fire. And that fire grew to become the second largest in California history. So Patty, upon understanding what happened, went up to Butte County where Paradise is located, and she promised that the utility company would underground 10,000 miles of distribution wire, essentially eliminating the risk of fire on those circuits. And that has the potential to really change the whole risk profile of the system, but there are a lot of challenges, namely that it's expensive. The plan's probably going to cost $20 billion at least. And the company has said it can drive down the costs of doing so over time, but it's a long-term plan, and they still need to do a lot of near-term spending. And as we know, we're in an inflationary environment in which power costs have been going up, and rates in California are already some of the highest in the country. So managing spending is going to be a real challenge in executing this plan.
And so, talking about PG&E's plans, what about the state of California? I mean, has there been any consideration on what the public sector can do here, how they can change?
So certainly there's been a lot of initiatives within the last several years within the California Public Utilities Commission to exert greater oversight over PG&E, as well as the state's other large utilities, which are Southern California Edison and San Diego Gas and Electric. All three face substantial wildfire risk, and all three have to take a lot of risk mitigation measures in the near term, while also spending heavily on the system to prepare for greater electrification as more electric vehicles are added to the system and more homes are electrified and the like. So the regulator has really attempted to beef up its safety oversight and created new requirements for the companies in an effort to get ahead of the risk. But historically speaking, the regulator has been very challenged to keep very close watch over each of these companies by virtue of the fact that they are very large. They're very large companies.
Catherine, this is all happening at a time where California has aggressive goals to reduce emissions. We saw the news recently that they want to ban internal combustion vehicles by 2035. And then, of course, there's also just the move from Gavin Newsom to try to create more energy from renewables right now. Does the grid, we have a story on the Bloomberg today about grids not being able to handle renewables. What does California's grid need to do in order to modernize and get there?
Sure. So each of the utilities have large investments to make to, improve the overall capacity of aging infrastructure, improve the health of aging infrastructure. There's wide agreement that more transmission across the West, in California and across the region, will be necessary to support the addition of new wind and solar farms, as well as batteries, to store the output for use when production declines. Each of the utilities have very large capital plans aimed at helping to integrate renewables and do more to prepare for greater electricity demand. In the United States, electricity demand has largely plateaued for a while as a result of energy efficiency measures and other things, but we're preparing for an uptick as a result of more EVs, and clearly California is pushing very hard in this direction with the recent announcement, as you referred to. But managing the pace of the transition has been a challenge. It's why you're hearing talk about extending the life of the last nuclear plant in the state to help make sure that there's concrete baseload power for use when in the evenings, especially when solar production declines. It's been a challenging few years for California for sure. Yeah, and I anticipate it will continue to be challenging for my home state there. Catherine Blunt, she's renewable energy and utilities reporter for the Wall Street Journal. She's the author of the new book. It's out today. It's called California Burning: The Fall of Pacific Gas and Electric and What It Means for America's Power Grid. She joined us this afternoon via Zoom from San Francisco. You can check her out on Twitter at Catherine Blunt as well. Well, that is going to do it for Bloomberg Business Week on this Tuesday afternoon. A big thank you to Katie Greifeld for holding down the fort in the Bloomberg Interactive Brokers studio, and the entire team at Bloomberg Business Week for making it all happen. You're listening to Bloomberg Radio.